Let me ask you something. If someone handed you $100 right now and told you to invest it, what would you do? Most people would freeze, not because they are not smart enough, but because nobody ever actually showed them how. Investing sounds like something that requires a finance degree, a broker in a suit, and a lot more money than most people have sitting around. So people do nothing. And doing nothing, as we are going to talk about today, is actually the most expensive decision you can make. This is everything you need to know about investing, explained simply in 10 minutes, starting right now. First, let's get one thing straight. What does investing actually mean? Investing means putting your money into something with the expectation that it will grow over time. That is it. You are not gambling. You are not speculating. You are making your money work while you sleep. The alternative, leaving your money in a regular bank account, sounds safe, but is actually slowly losing value every single year because of inflation. We have talked about inflation before on this channel. It is the silent thief. Investing is how you fight back. Now there are many ways to invest: real estate, businesses, gold, crypto. But today, we are focusing on the most beginner-friendly, most proven, most accessible option available to almost anyone in the world: the stock market. Specifically, index funds and ETFs. These two things are how most ordinary people build real wealth over time, and I'm going to explain exactly how they work. So what is a stock? When a company wants to raise money, it sells small pieces of itself to the public. Those pieces are called stocks, or shares. When you buy a share of a company, you own a tiny piece of that business. If the company grows and becomes more valuable, your share becomes more valuable too. If it struggles, your share drops in value. Simple enough. Now here is where most beginners go wrong. They try to pick individual stocks. They hear about a company doing well. They buy shares, and then the company has one bad quarter and the stock drops 40%. Picking individual stocks is incredibly difficult even for professional investors. Studies consistently show that the majority of professional fund managers, people whose entire job is picking stocks, fail to beat the average market return over 10 years. If the pros cannot reliably do it, you and I definitely should not be trying. This is why index funds exist, and this is the part that changes everything. An index fund is essentially a basket. Instead of buying one company, you are buying a tiny piece of hundreds or even thousands of companies all at once. The most famous example is an S&P 500 index fund. This tracks the 500 largest companies in the United States. When you invest in it, you own a small slice of Apple, Microsoft, Amazon, Google, and nearly 500 other companies simultaneously. If one company crashes, it barely moves your investment. If the overall economy grows, which historically it does over long periods, your investment grows with it. ETFs, or exchange-traded funds, work almost exactly the same way. The main difference is that ETFs trade on the stock market throughout the day like a regular stock, making them very easy to buy and sell. For beginners, ETFs are often the simplest entry point because you can buy just one share, sometimes for as little as $10 or $20, depending on the platform. Here is the number that makes all of this worth paying attention to. Historically, broad market index funds have returned an average of around 7 to 10% per year over long periods. Now compare that to a typical savings account paying 1% or less. On a $1,000 investment over 30 years, the difference between 1% and 8% is not small. At 1%, you end up with around $1,300. At 8%, you end up with over $10,000. Same starting point, completely different outcome. That is the power of compound growth, your returns earning returns, year after year. So how do you actually start? Step 1. You need a brokerage account. This is just an account specifically designed for investing. Depending on where you live, popular options include Fidelity, Vanguard, or Charles Schwab in the US. For international investors, there are platforms like Interactive Brokers, eToro, or local equivalents in your country. Most of these are free to open and have no minimum deposit to get started. Step 2. You deposit money. Even $50 is enough to begin. Step 3. You buy an index fund or ETF. Search for something like VOO or SPY for S&P 500 exposure, or a total world index fund if you want broader global diversification. Step 4. You keep adding money consistently, every month, every paycheck, whatever you can manage. And then you leave it alone and let time do the work. Now let me address the thing everyone is thinking. What about market crashes? What if I invest and the whole market drops? This is the fear that keeps most people from ever starting, and it is worth addressing honestly. Yes, markets crash. They crashed in 2008. They crashed in 2020. Every time they eventually recovered and reached new highs. If you are investing for the long term, 10, 20, 30 years, short-term drops are not losses. They are actually opportunities to buy more at a lower price. The only people who truly lose money in a crash are the ones who panic and sell. The people who stayed invested came out ahead every single time. One last thing. The best time to start investing was 10 years ago. The second best time is today. You do not need to understand everything. You do not need to time the market perfectly. You do not need a lot of money. You just need to start. Open an account this week. Put in whatever you can. Buy a simple index fund. Set up a recurring deposit if you can. And then let time work in your favor. Money is a tool. And right now, most people are leaving that tool sitting in a drawer doing nothing. Pick it up. If this helped you understand investing for the first time, subscribe. We post simple money tips every week. No jargon, no fluff, just things that actually make a difference. See you in the next one.